Let's talk to Bill Blain. He's a strategist at Mint Partners. Bill, very good morning to you.
Good morning, Moose.
Right, so you love a soapbox. I'm going to press the old chess player. 6 minutes, off you go. What's going on?
Well, I think the big issue today is where are markets going? Over the last 2 weeks, we've had some remarkable ructions and royals, which we're now beginning to call the volatility VIX crisis. I would say it's really been a crisis of value at risk, because it's going to change the way that investors and banks look at the risk that they're addressing just now. So they're going to change their parameters so that they face a different way of acting when the market does the same thing. But I think it's been quite extraordinary, some of the stuff we've seen in the last 2 weeks in explaining what's going on. We've heard people variously tell us that it's been signs of greater inflation that have driven the market to the extremes that it went through. Well, if you actually step back and look at inflation, it's still below trend. It's still below the level that central banks would get worried about. Then we've had people tell us that it's the bond market.
Yep.
Well, even though the bond market, the 10-year US Treasury being the key rate that we're all watching, has gone to 2.9% at points, it's really not at a level where we need to be panicking. Yes, we're into a changed bond market where rates are going to rise. Yes, we're going to see central banks tightening rates this year, that they're only going to tighten towards the kind of rates that were normal 10 years ago. We're going through this normalization process as quantitative easing comes to an end and we go back to what we're now calling or nicknaming quantitative tightening. Now, these two things, inflation rising and interest rate rising, that should of course be warning signs to the market, but as I've said, neither of them is going to be extreme. Then you've got things like how much money is still trying to get into the market. We know there's a wall of money still trying to find things to invest in. So there's still money that's available to go into stock markets. You're going to see rotation out of the bond markets and into stocks. And then finally, of course, we have all this US tax repatriation money, where you've got companies like Apple have somewhere in the region like 200 billion of cash to repatriate into the US, which they are largely going to invest in stock buybacks, which should be pushing up prices. These things look favorable in terms of the monetary factors. And then we've got the economic fundamentals, which are all looking very strong. We're still on path for global growth. Now, there are a number of people saying, the US recovery is looking quite tired. Are we going to see recession start sometime in 2018 or more likely 2019? That is a big concern, but I think that's going to vanish in the next few months as we see US rates continue to perform. Yes, there is a lack of capacity in the US economy. We're running out of workers. That's why wages are starting to go up. Speak to anyone, they'll tell you that wage inflation is going to happen, but there is still plenty of unfilled demand in the economy and plenty of ways they can dislodge the bottlenecks that are blocking the economy. So I don't think there's anything to worry about then. Why then are we also worried about where the markets are going to go? Well, I think that's a step back and take a look and figure out what's gone on in the last couple of years in terms of looking at charts. We all know that when a stock market chart goes parabolic,
Yep.
that at some stage it's going to get to the top, and then it does the other thing, which is goes parabolic on the other side. I think you've got to feel that the way that stocks have risen in the last 3 years, and remember this began in 2016, this was not just a 2017 phenomena, have we reached a top in the stock markets? And that's what's really got me thinking. Although we've got strong fundamentals, although interest rates are not yet a major fear, although inflation is going to rise but within trend, where are valuations in the stock markets? We know they're high. Why are they so high? And I think one of the reasons is if we sit back and think about quantitative easing. Now, quantitative easing was designed to pump money into the bond market by buying back bonds so that investors would then have that money to invest in real financial assets, creating growth in the economy. Now, we know that never happened. What happened was that investors very quickly realized that if they followed the central banks who were doing quantitative easing and started buying the same things they were buying, that meant they were going to see upside. So we saw bond markets rise dramatically, and as yields fell, because that's what happens when bond prices go up, yields go down. As yields fell in the bond market, we got the concept of yield tourism, which meant that guys who were normally buying government bonds started buying corporate bonds. And when the yields in corporate bonds got to the same level as government bonds, they started buying higher risk, high yield bonds in emerging markets. And once they were so tight, they started to buy equity. So we've seen all financial assets get stronger and stronger. Prices have gone up, which feels like a great thing if you're sitting on a stock market rally or a bond market rally. But the fact is, that's where inflation is. It's in stocks and bonds. They've both gone up dramatically, whereas the real economy, we've seen prices pretty flat. We're only now beginning to see the real economy start to recover. That inflation that is embedded within the bond and stock markets is what really worries me, because A, it infers that they're overpriced, and B, what is going to be the transmission mechanism by which they're going to spread to the real economy. In the next few years, we are going to see bottlenecks emerge as growth continues. We're going to see wage-driven inflation. We're going to see inflation from all the normal things, especially in the US, where, of course, the dollar is now plunging to lows. So that will create inflation there as well, and that will end up being exported. At the moment, the low dollar is very good for all the emerging economies and in the way that it can export commodities and such, but that, I think, is a short term. Long term, we still have to deal with the unintended consequences of quantitative easing, and I think that's one of the reasons why the markets are going to remain fundamentally nervous, and we aren't going to get back onto this parabolic upwards growth in stocks.
Bill Blain?
How was that in time?
Thank you very much indeed. Time is up. Thought-provoking as always. Clearly a soapbox. Thank you.